If I handed you $100,000 right now, would you invest it in an ETF that pays you thousands in passive income every month? Or one that could turn that same investment into millions over time? Alright, imagine this. You have $100,000 to invest today. Now comes the big question. Would you rather have an investment that pays you thousands in cash flow every month, or one that could turn your $100,000 into millions over time? This is the real debate between SCHD and SCHG, two powerful ETFs, but with completely different strategies. One focuses on steady dividends, rewarding you with passive income year after year. The other, it's all about explosive growth, aiming to multiply your money over decades. But here's the thing. You can't just pick one without knowing the trade-offs. Choosing the wrong ETF for your goals could mean losing out on millions. So, in this video, we'll break it all down. Performance, risks, dividends, long-term projections. And by the end, you'll know exactly which ETF is the right fit for you. Chapter 1. Overview of SCHD and SCHG. Let's start by understanding what these two ETFs actually do. First up, SCHD, the Schwab US Dividend Equity ETF. This one is all about dividends. It holds companies with a history of strong, consistent payouts. Think of Coca-Cola, Pfizer, and Chevron. Big, stable businesses. Since its launch in 2011, SCHD has become a favorite for income-focused investors. It has a low expense ratio of 0.06% and holds 103 stocks. With 50% of its weight in the top 10 holdings, it's built for stability. Now, let's look at SCHG, the Schwab US Large Cap Growth ETF. This one is the opposite of SCHD. It focuses on high-growth companies, reinvesting profits instead of paying dividends. The top holdings? Apple, Microsoft, Nvidia, and Amazon. Since its launch in 2009, SCHD has dominated in bull markets. It's tech-heavy, with almost 50% of the fund in technology stocks. Its expense ratio is even lower at 0.04%. So, one ETF prioritizes dividends and stability, while the other chases rapid growth. But which one is actually better for long-term investing? Chapter 2. Historical Performance Comparison. To answer that, let's look at their performance. After all, the numbers don't lie. Over the past year, SCHD returned 9.96%. Nothing flashy, but steady and reliable. SCHG, on the other hand, surged 34.8%. That's a huge difference. But 1 year isn't enough to judge an investment. Let's zoom out. Over the past 5 years, SCHD grew by 42.31%. SCHG, 122.9%. Almost 3 times more. And what about the past decade? SCHD delivered an 18.44% total return, a solid mix of price appreciation and dividends. But SCHG, a staggering 15.93% annual growth rate. So, what does this tell us? SCHG wins in total return. It thrives in bull markets, especially with tech stocks leading the way. But does that mean it's always the better choice? Not necessarily. SCHD is built for stability and income, not just stock growth. While SCHG can skyrocket, it also comes with higher risk. We've seen that in market crashes. SCHG falls harder. So yes, SCHG has historically outperformed, but higher returns come with higher volatility. And that's exactly what we'll talk about next: risk and volatility. Chapter 3. Risk and Volatility. Because higher returns always come with a catch: volatility. SCHD is the steady ship, It has a lower beta, meaning it doesn't swing as much when the market moves. That makes it less stressful to hold, especially during downturns. SCHG, on the other hand, it's a roller coaster. It has a higher beta, meaning bigger price swings. When the market is booming, SCHG soars. But when things crash, it falls much harder. A perfect example? 2022. The market struggled. SCHD dropped about 5%. Not great, but manageable. SCHG, it plunged over 30%. That's the risk of a tech-heavy fund. So, what does this mean? If you want stability and lower risk, SCHD is the safer choice. If you can handle big swings for the chance at higher long-term gains, SCHG might be worth it. Now, let's move on to dividends and income potential, where SCHD truly shines. Chapter 4. Dividend Yield and Income Potential. SCHD isn't just about stock growth. It's designed to pay you year after year. Right now, its dividend yield is 3.61%. That means for every $100,000 you invest, you'll earn about $3,610 per year in passive income. But it gets even better. SCHD's dividend growth rate is 11.04% annually. That means those payouts keep increasing over time. And if you reinvest those dividends, the compounding effect is huge. SCHG, on the other hand, is not built for income. Its dividend yield is just 0.42%. That's $420 per year on a $100,000 investment. Barely noticeable. Its focus is on growth, not paying out cash. So, what's the trade-off? SCHD gives you steady income, great for retirement or cash flow. SCHG reinvests everything for bigger potential gains later. It all comes down to your goal. Do you want monthly income without selling shares? Or do you want maximum portfolio growth? Next, let's talk about fees and expense ratios, because even small costs can add up over time. Chapter 5. Expense Ratios and Fees. SCHD has an expense ratio of 0.06%. That means for every $10,000 you invest, you pay just $6 per year. Pretty cheap. SCHG is even lower at 0.04%. That's $4 per year per $10,000 invested. Almost nothing. Both ETFs are extremely low cost, which is great for long-term investors. You're not losing money on high management fees. So, when it comes to expenses, SCHG wins by a tiny margin. But now, let's see how that $100,000 investment actually grows over time. The results might surprise you. Chapter 6. 3-year growth projection with $100,000. Now, let's put the numbers to the test. What happens if you invest $100,000 in SCHD or SCHG today and hold for 30 years? Let's start with SCHD. With a 3.61% dividend yield and 11.04% dividend growth, plus an average 7.81% annual share price increase, your $100,000 could grow to $4.79 million after 30 years. But here's the best part. You'd be earning around $369,000 per year in dividends alone. That's over $30,000 per month without selling a single share. Now, let's look at SCHG. With a higher 15.93% average annual growth rate, but low dividends, that same $100,000 could turn into $8.78 million in 30 years. But here's the catch. Your annual dividends would still be under $1,200, hardly enough for passive income. So what's the takeaway? SCHD builds a massive income stream, great for retirees or anyone wanting cash flow. SCHG, on the other hand, builds a massive portfolio, perfect for long-term growth, but you'll need to sell shares to use the money. Both strategies work, but the right one depends on your goals. I know you're a little confused right now, but don't worry, because next up, we'll figure out which one is best for you. Chapter 7. Who should invest in each ETF? Let's break it down. We'd recommend choosing SCHD if you want passive income. It's perfect if you're planning for retirement or just love the idea of monthly cash flow. With its strong dividends and lower volatility, SCHD is ideal for long-term stability. You won't see crazy stock prices, but you'll collect steady income for life. Now, going with SCHG makes more sense if you want maximum growth. If you don't need income now and can handle market ups and downs, SCHG is built to multiply your money. It thrives in bull markets, making it a great choice for investors with time on their side. But what if you want both? Many investors combine SCHD for income and SCHG for growth. A mix of both ETFs could give you the best of both worlds. So, which ETF wins? The truth is, it depends on your goal. If you want steady cash flow, SCHD is the better choice. With high dividends and lower risk, it's perfect for passive income seekers. If you want explosive growth, SCHG takes the lead. It's built for long-term capital appreciation, making it great for investors who can handle volatility. Or you can do what many investors do. Own both. Balance income and growth for the best results. So, which would you choose? $30,000 per month in dividends or an $8 million portfolio? Let me know in the comments.